How to determine the market value of a property. Have you ever wondered how to figure out what a property is really worth? Understanding the market value of a property is key in real estate investing. It helps you make smart decisions when buying, selling, or financing. Market value is the estimated price a property would sell for between a willing buyer and seller, both informed about the relevant facts. To determine market value, there are three main methods you can use. The first is the comparative market analysis, often called the sales comparison approach. This method looks at recent sales of similar properties in the area. You compare features like size, location, condition, and amenities of the property you are interested in with those of recently sold homes. Adjustments are made for differences to come up with a fair market value range. This method is especially useful for residential properties since it relies on actual sales data. The second method is the income approach. This is mainly used for properties that generate income, like rental buildings or commercial spaces. It estimates value based on the income the property produces. A key factor here is the capitalization rate, which is the ratio of net operating income to the property's value. By looking at similar properties' cap rates and their income, you can calculate the market value by dividing the net operating income by the average capitalization rate. This approach reflects how much the property can earn in the current market. The third method is the cost approach. This calculates market value by estimating how much it would cost to replace or reproduce the property. You add the land value and then subtract any depreciation due to age or condition. This method is particularly useful for unique or newly built properties where comparable sales may be hard to find. The formula is simple. Property value equals replacement cost of building minus depreciation plus land value. When investing in real estate, it is important to understand the difference between assessed value and market value. The assessed value is determined by local tax authorities for property tax purposes. It may not reflect current market conditions or the true investment potential. Market value is what you should focus on since it influences the price you might pay or receive in a transaction. To practically determine market value, start by conducting a thorough comparative market analysis. Gather data on recent sales of similar properties nearby. If the property generates rental income, calculate the income approach value using net operating income and market capitalization rates. For unique or newly constructed properties, estimate replacement costs and depreciation. Consulting professional appraisals can also provide an expert valuation that combines these methods. Finally, keep an eye on local market trends, economic factors, and the property's condition, as these all play a role in determining market value. By using these methods, you can arrive at a well-supported estimate of a property's market value. This knowledge will help you make informed investment decisions and negotiate effectively in the real estate market.